All right, guys, welcome back to our revision class. So we are going to continue from where we had stopped, and we hopefully going to do another question as well, just to finish off. So yeah, I do understand that you guys are writing on Wednesday. You're writing on Wednesday. It's already Monday, so I believe everybody is studying. If you are not studying yet, you're not doing well. You're not making a good decision. Okay, please, if you haven't started, please start. Start studying, guys. Give it your best. This is your last shot. Give it your best. Remember, there is another alternative that you can also write again. Yeah, I always beg students always to write. Please do write the other exam as well. Just write it. You never know which one you're gonna do better in. They'll check the best mark. So please do write. Everybody just write it if you can. All right. Also, I wanted to just warn you guys again. A lot of people are not submitting the exams. A lot of people. Please don't study so much only for you not to submit the exam. And remember, when you're writing, give it at least 30 minutes of your submission. Okay. As long as you're done, you are left with 30 minutes, stop writing and submit. Please, guys, I really want to beg you with this one. I think I've said it the last class. I'm saying it again. A lot of students are not submitting. So the online exams. Okay. So just please be careful with that. Don't be trapped into that. Please be careful with that. Okay. Anyways, let us continue with our class. Let us continue. Right. So we did question 2. We're busy with question 2. Yes, we did question 2A. Right. So we had done we did A and B. We ended with B. Right. We're supposed to write an email to talk about the measurement, investment in global limited bonds. We did that. Then we did calculate the consolidated profit for the year attributable to the owners. We did that. Now, the profit that we did not finish it off. We are still waiting for the NCI portion. Let me just go. Okay, so this was our profit. All right, this was the total profit. Let me just say total. Right, for us to get the portion attributable to the parents, profits attributable to parents. So for us to get that, we need to calculate the profits of the NCI profit. All right. Okay, you could do, there's shortcuts to do this, but I prefer to do this in the analysis of honest equity because we are going to use it anyways. We are also going to answer the questions we have here, we supposed to prepare the non-current assets and equity sections of the consolidated statement of financial position. So we're still going to use that part. So I'm going to do the analysis on that side for us to cover that. Okay. So I'll do the analysis as a calculation. So we already have calculation 1. I'm going to do calculation 2. Right. So in this group, we have subsidiary and joint venture. So I'm going to start with the subsidiary one because we need the NCI profit to finish up our question, right? So I'm going to start with the subsidiary analysis. So it's going to be analysis of owner's equity so the name of the subsidiary company is Zahara Limited. So analysis of owner's equity of Zahara Limited. All right. Okay, I'm sure everybody should know this now. Like everybody, whenever we have to do analysis, everybody should just be drawing like this at this point in time because I think we have done a lot of studying, right? The good thing about FAC3764, the way it's structured, it forces you to study because you had several tests that you had to write. And for you to write those tests, you studied every time. And every time you studied, it was preparing you for this exam that you're writing on Wednesday. Right. So like you were forced to study. So there is nobody here who can say they've never studied because how did they write other tests? You see, that's the good part of this structure where they remove the assignment because most people when it's assignment, they don't do it. They just get somebody to do the assignments for them. Right. But with tests, they will study and write. So all of you have studied and you are prepared because you have touched the whole syllabus before you can even get to the exam. All right. Anyways, let's do our analysis. So this is my total column. The parent company is Spree. Just double check. Spree Limited. Right, and Spree Limited has 60%. So the parent company is Spree Limited with 60%. Right, at since. All right, then let's add my percentage. 60. The NCI will have 40. Now I'm writing no instead of 40. The NCI would have 40%. Okay, and then the total column is my 100%. All right, so we start at acquisition, and in this group, basically most of them were purchased. This one, I think this one in particular was purchased a bit long time ago. I'll always go back to my structure. This is what governs me on what to do. So I come back here, I check my dates. It was purchased on the 28th February 2021. All right, and my financial period. My financial period is the 30th of June 2023. So it was purchased in 2021. That means we're going to have 3 stages at acquisition, since acquisition, and the current year, right? So let's go back to the information that talks about Zahara investment in Zahara Limited. It is number 2, actually, it is number 2. Okay, so we are given that on the 28th February 2021, Spree Limited acquired a controlling interest in Zahara Limited by purchasing 240,000 of the issued ordinary shares. The total purchase consideration of 950,950 was settled in cash on the same date. So this is the amount we paid, 950,950 for the interest. The acquisition of the interest by Spree Limited met the definition of a business combination in terms of IFRS 3 business combinations. And on the 28th February 2021, the share price of Zahara Limited was listed on the market value as 3.70 per share. On the 30th June 2020, the returned earnings amounted to, okay, I think I wrote on the amount. Let me just do this. Amounted to 529,140. The profit for the year 2021 amounted to 816,201. So what they did for us is they separated the profit for 2020 and 2021. So we are interested in the return earnings at 28th February 2021, this date. So that my return earnings should be on that date, not on the 30th of June 2020. All right, so just be careful with that. Anyways, so that is what is given, and then it says at the date of acquisition, all the identifiable assets and liabilities of Zahara were fairly valued except for trade receivable, which had a carrying amount of 229 and went down to 185, and then we had contingent liability of 53,000. Anyways, let's finish off. Let's do this. So we have with us here, we have share capital. Right, remember share capital is not going to change. We can get this from the trial balance. All right, then we have returned earnings. Right, I want to deal with these two before I can look at the adjustments. So my share capital, I can go to my trial balance, look for share capital. I'm looking for the rent value for Zahara. So Zahara share capital is 400,000. All right, so I'm going to go down 400,000. That's my share capital. Okay, and then for retained earnings, so with retained earnings, we're going to do some calculation to it, because the retained earning I need is at 28th February 2021. That's the date of acquisition. Very important. So we go there. We are told, number 2. So we were told that on the 30th of June 2020, the retained earnings had a credit balance, which is the positive balance of 529,140. 529,140 plus. Then we were given that the profit for 2021, the 2021 financial period, right? It was 816,201. 816,201. So that was the profit for 2021. 2020, that was the retained earnings balance. So we want to calculate up to 28 February 2021. So from June, so it's July 2020 to July, August, September, October, November, December, January, February. I repeat, July, August, September, October, November, December, January, February. So it's basically 8 months. All right. So we're going to calculate profit for 8 months, which will be now when we do this, we are now on this date. And that's the date where we need our retained earnings to be from. Please do the calculation along with me so we can move faster. Right, I'll start with the smaller bracket. 806,201 multiplied by 8 divided by 12 plus 529,140. Okay, how much are we getting? All right. Please.
537.
You got?
537. 537,467.
For which one?
For 806,201 multiplied by 8 over 12.
Oh, sorry.
I did that portion only.
Oh, you did the portion only. Okay, let's get the total. Let's get the total. And it's actually 816, ne? It's actually 816. Right, 816, not 80. I don't know where I got the 0 from. Let me just fix this. Please, I want everything. So I'm also gonna do that. Do that. 816,201 times 8 divided by 12 plus 529,140. Okay. Please, I'll write the amount, then you let me know. You confirm. So 1,073,274.
It's correct.
Perfect. Right, so that's my return earnings. And then we also had other adjustments. We had trade receivables that were written down. So we had trade receivables and we had contingent liability. So trade receivables will have a tax effect. Right, so let's do this. Trade receivables. I want to do this one in red. These are adjustments. Trade receivables. Right, so we'll do the difference, the fair value, and the carrying amount. So it is 229,520 minus 185,000. So it has gone down, right? So this is a loss. So 229,520 minus 185,000. This is 44,520. Right, this has gone down. Then, of course, it's going to have a tax effect. Tax effect, 44,520 times 27%. Okay, please confirm the figure. I'm getting 12,020.
It is correct.
All right. As much as I always say confirm figures and all that, because we want to move with correct figures, but the most important thing is the principle. It's not really about the amount. It's about, ability to get it, to understand what is happening. So that's the most important. So even if you can get the amounts right, if you don't understand why you are doing something, then there's a problem because the next test will have different amounts. So make sure you are understanding what we are doing, all right? That's the most important. Okay, so another one we had was the contingent liability. So I think I've explained this. I'm going to explain it again. Guys, contingent liability is not a liability in terms of financial statements, in terms of conceptual framework, and so forth. All right, it is not a liability. So we do not account for it as a liability in our financial statements. However, an exception happens when there's business combination. It's only when there's this combination at acquisition that's when we account for the contingent liability figure. But normally we do not account for contingent liability. It's normally we only treat it as a note, a separate note. All right. So it's only with business combination, or we can even say consolidation, only because of that. That's why that's the only time we touch on contingent liability. So you will take the figure as is, 53,000. They gave us a story here. I'm just going to read it. It says, at the date of acquisition, Zahara Limited disclosed a contingent liability amounted to 125,000 relating to a lawsuit in its separate financial statements. While the claim represents a present obligation, however, the lawyers for Zahara Limited believed the prospect of the outflow of economic benefit was not probable, right? It's not a provision because it's not probable, right? It was not probable at the time since there was insufficient evidence to support the claim. The fair value of the contingent liability was estimated to be 53,000 at the time of acquisition, of the date of acquisition. The South African Revenue Service will not grant a tax deduction. They did say they will not grant a tax deduction should the claim be successful. The fair value adjustment on all items above were not accounted for in the separate accounting records of Zahara. Now they gave us two figures here. They said it was first accounted for as 125, and then the fair value is 53. We are not going to do the difference because of the explanation I'm giving you guys. Remember, it was not initially accounted for. Like, they can't really account for it in the statement. They make a note. We only give out a note. All right. So we cannot now start making a difference, like getting the adjustments between 125 and 53. No, we will use 53 as that because it's only being used because of business combination. So it's like it was from 0 to 53. And I think it's even well explained here. You see, they put a dash here to say there's no carrying amount. But on the explanation now, it can come to confuse you. So you need to go back to principle. If you understand what contingent liability is, it cannot confuse you. But somebody who does not understand what contingent liability is, they will end up taking the difference between 125 and 53. Remember, this was just a note. This was just a note. Because it's a contingent liability, you are only supposed to show a note. But now, because of business combination, now we have to account for the fair value of the contingent liability. Okay, so it is like it is. You take the 53 just like it is. Also, the tax, we are also told that SARS will not grant a tax deduction on this, so there is no tax effect on it. All right, so we'll just come here and say contingent liability, and it's 53,000. Right, it is a liability, so it's going to decrease our figures. It's going to decrease our figures because it is a liability. Okay, so those are all the items that happened. I don't think there is any other that occurred. That was the last thing that they spoke about before we started looking at the transaction since acquisition, right? So we then can close this, calculate the total. Right, so it's 400,000 plus 1,073,274 minus 44,520 plus 12 and 20 minus 53,000. All right, so I'm getting 1,387,000. 1,387,774. Right. Are we getting the same?
Yes, it's correct.
Perfect. So then we take that figure, multiply by 60%. The parent portion will be 832 and then 664. Right. Then the NCI portion. NCI portion is 110. Please confirm the figures. Especially the NCI one looks a little bit weird. Please confirm. Okay, I also just want to straighten my line.
It's correct.
Right, thank you. Guys, why is she the only one calculating? Where are we? Don't we have calculators? Hey guys, you're too quiet. We are close to writing. We should be talking this accounting now, you know. should be speaking accounting. Right, so we skip a line to get our consideration paid. Consideration paid and our NCI. Right, the consideration paid amount, I remember it very well, 950, 950. Okay, that was a very weird looking number. All right, then from there, it's very obvious that we paid more than what we are receiving, and therefore we are going to have a goodwill. Okay, so it is 950, 950 minus 832,664. This is 118,286. All right. Then the NCI, we have to now know which method is going to be applied with NCI. So we're going to go to the end and work our way back to the front. So we work our way up, looking for where they are talking about NCI, which I think is number 14. Right. So in 14, it says Spree Limited Group elected to measure non-controlling interest in acquiring at fair value at the date of acquisition. Now, they usually love the proportionate share. I've noticed they love the proportionate share, but it's possible, you see, in this question, they did use the fair value method. And I could already pick it up when they were giving us the price per share. As we're reading the information, they keep on saying the market price on the day was so much, the market price on the day was so much, and so forth. So that already gave an indication that that's what we'll be using. Okay, anyways, let's calculate that. So we go first to the number of shares for Zahara. Zahara Limited had 400,000 ordinary shares. This is the number of shares, not the rent value, right? So it had 400,000 number of shares. We're going to multiply this by the 40% that they have. Let me open the bigger bracket. Right, so we multiply this by 40%. So we're only looking at 40% because we're doing the calculation only for NCI. Right, then what was the market price per share at acquisition, guys? At acquisition. They can give you different market prices. You are interested in the one on the day of acquisition, which was the 28th February 2021. That's the date we are interested in. And it has to be given somewhere here. So it was here. It says on the 28th February 2021, the share price of Zahara Limited was listed on the market value of 3.70 Rand per share. All right. This was 3.70 Rand. So 400,000 times 40%, which gives us 160,000, multiplied by 3.70 Rand. So this gives me 595. Let me do this one in color. 592,000. Right? And therefore, it's 9?
You are correct.
Oh, all right. Thanks. And then we can see that it is bigger than the equity being received. Therefore, this is going to give us a goodwill, right? So we'll take this value minus 555, 110, and this will give us 36890. Okay, so we have 36890. Right. So that was that. And then we can calculate our total goodwill by adding the two goodwills together. You saw, guys, I calculated them separately. There's no way you can calculate them together because of the way information is given. All right. And besides, these are two different owners. You cannot calculate the goodwill together. You have to do the goodwill separate according to whatever arrangement they have. And then after you do the goodwill separate, you then add them together to become to totalize them. You then totalize them. But you cannot add them together. Ne? You can't find them together. All right. So our total what am I even saying now? Okay, so our total goodwill that we got is 155,176. Okay, and with that I can calculate my total value now. Okay, so I'm getting 1 change the color. I'm getting 1,542,950. Right, so at acquisition, basically that's what happened. You can see there was some transactions there, and so that's what happened. Guys, does anybody have issues here? Because this is definitely going to be in the exam. Does anybody have an issue here? Anybody struggling on how to do the analysis? Okay, so it's good. Guys, groups is your opportunity to score high. Groups is that opportunity for you to do well. It's your opportunity to pass on Wednesday. So please, no matter what happens, like don't fail groups. Yeah, don't, because there are gonna be some tricky things. You know how it is with CGU and all these what you call impairment and what can be complicated sometimes. They can trick you there, but with groups, there isn't much they can do with groups seriously to trick you. There isn't much. So please, it's your opportunity to really score high. Right. At acquisition, let's go. The next thing we are looking at now, since acquisition. Since acquisition. All right. So then, since acquisition, we want to understand what is the movement in retained earnings and also check if there is intragroup transactions that affected us on this period. So this period is the period between after the acquisition date and before the beginning of the current year. All right. So we'll start with our retained earnings. Here we want these retained earnings to be adjusted. So then we look at the movements in retained earnings. Okay, we want retained earnings at the beginning of this year versus retained earnings at acquisition. So the beginning of this year, let's go to our trial balance. Retained earnings, there is retained earnings. The beginning of this year is 2,019,191. 2,019,091. 191. Right, 2,019,191. All right, so that is my return earnings at the beginning of the year. I will then take this minus the return earnings at acquisition, which was 1,073,274. 274. Right, so we calculate the movement. So 2,019,191 minus 1,073,274. Okay, so this is giving me 945,917. Right, please confirm the figure.
It's correct.
All right, awesome. Okay, so we continue. So we take that figure, we will calculate 60% of the figure as well as 40%. So 60% gives us 567,550, and then the 40% is 378,367. All right, so that is my movement. Now, please don't forget, any current liability or current asset must be reversed in the next period because they are realized within 12 months. Remember why they are current assets is because it's shorter than 12 months or they have movements. Okay, so any current assets or current liability item, the adjustment, I'm talking about adjustment on them. So adjustment on current asset or current liability must be reversed on the next period. Now, in this situation, the next period is the since acquisition period that we are in. So we have to reverse the trade receivable that we had as well as its tax effect. Okay, it has to be reversed. Right, so we'll come here. We'll come here. And then we got our trade receivables. Our trade receivable value was 44,520. Right, and then the tax effect. So you see now I'm adding it instead of minusing, and of course its tax effect is going to have an opposite effect as well. Now this is being minused. It was 12,020. Okay, so that's basically it. The contingent liability, you leave it alone, you don't do anything with it. All right, so we continue. That was since acquisition. We go and check now, do we have any intra-group transaction that falls within the since acquisition period? All right, so that's what we're checking now. So we're going to go to transactions between the number 3, transactions with Zahara Limited. All right, so we've got 3 and 4. So number 3 says Zahara Limited sold inventory to Spree Limited from 1 August 2022. So now, guys, our year ends on 30 June. So I'm going to put it here. Our year ends on 30 June 2023. It begins in 1 July 22. Now, this was sold in August, somewhere here, July, August. So it's within the current year. So this is not in since acquisition. So it will not go to since acquisition. This affects the current year directly. All right. Then, so that one is out. We are not going to use that one. Let's go to number 4. On number 4, it says on 1 January 2023, Spree Limited. January 2023 is also in the current year. Spree Limited sold inventory, machinery to Zahara, and besides, this is the parent selling to the subsidiary. Therefore, it will not form part of the. It will not form part of our analysis. All right. So those are the 2 transactions that occurred with Zahara and Spree, the parent. The next one is talking about Isabella, a different company. So those are the only transactions. All right, so that's about it. These are the only transactions that happen. That means we do not have intra-group transaction that affect our since acquisition period. Okay, so we continue. So I keep extending this because this is just showing that it's still longer. All right, so those are the only items in there. I've got 3 items. So now I need to find the adjusted retained earnings. So I'll put them in a box to get the total. All right, so 945, 917 plus 44, 520 minus 12, and 20. Right, so I'm getting 978,417. All right, so that is my returned earnings. Oh, I don't know why we shared this. I'm just seeing it only now that we're sharing this. Okay. It was not necessary to share when we just share the total rather. All right. Okay, so now we can share the total. 978,417. I hope you guys can see this well. It doesn't look very clear. All right, so we'll take this, multiply by 60% and by 40%. So this is 5, 8, 7, and 50. And then minus 978,417. This is 391,367. Please confirm the figure. Right, so that's my since acquisition.
Correct.
Thank you. That's my since acquisition. Then we now get into the current years. Guys, if you are still struggling with these, please practice until you get it right, because groups is that topic that should bring you marks. Né? And you can see, I just want to show you guys, this was the assessment 9 for last year, which is equivalent to your exam. And from groups, guys, of course, here we have financial instruments. But from groups, it's basically like, if you remove this, more like 38. All right, coming from groups alone. Okay. That is a lot. That is a lot, guys. That is a lot. So if you can understand your groups, you know that you're picking up your marks. All right. So current year, we want to adjust our profit. So profit for the year. Right. In the profit for the year, it's either going to be given to us or we have to calculate it. So let's see the information that we have. Profit is actually given to us in this question. All right. So we're just going to use the figure given. So it's given to us as 1,572,233. All right, so that's how our profit is given to us. The 2023, we are in the 2023 financial period. Right, so let's go and write it down. 1,572,233. So profit as given, it's 1,572,233. Okay, then we now go back to our intergroup transaction. Remember, there was an intergroup transaction that had occurred in August 2022. So we're going to go back to that one and we're going to account for it. All right, so let's go back to, it was number 3, if I'm not mistaken. Number 3. So Zahara sold. Now, it is the subsidiary that is selling, therefore subsidiary making the profit, and it must be included in the analysis, right? So Zahara sold inventory to Spree from August 2022 at a markup of 20% on cost price. They also love to use cost price. That does not mean they're not going to base it on sales. Né? So you need to know both. If it's on cost price, it's times 20 over 120. If it's on sales, it's times 20 over 100. All right. Total sales of the inventory made by Zahara Limited to Spree Limited during the year amounted to 732,600. And on the 30th of June 2023, before I move on, I think I spoke about this on the last class. These are sales during the year. Normally, if we had revenue and cost of sales, we would have gone to revenue and minus that in full. Would have gone to cost of sales and minus that in full as well. But when the profits are together, it's pointless because it's a zero effect. It's a plus minus. Né? Right, I explained it last week. Anyways, let me continue. On the 30th of June 2023, Spree Limited had inventory on hand amounting to 105,875 that was purchased from Zahara Limited. So we are interested in the closing balance, the closing inventory. We will use our closing inventory to calculate the unrealized profits. So 105,875 is 105,875. So we'll use that to calculate the unrealized profits on closing inventory. Unrealized profit in closing inventory. Right. So 105,875 times 20 over 120. Okay. 105,875 times 20 over 120. And I'm getting 17,645. 17,646. Actually 46 if you round it off. Yeah. Right. Please confirm.
Correct.
All right, thank you. So the tax effect also comes along with where the profits being affected. So 17,646 times 27%. Let's calculate the tax. Right, as for tax, I'm getting 4,764. Okay, tax is always going to have an opposite direction. It's always going to go on the opposite direction of what we are busy with. Okay, so that is that. And then we look for further intergroup transactions. Remember the second one, we had said that it is Spree Limited who sold, right? So it is the parent selling. And when the parents sell, the subsidiary is not making a profit, and therefore it must not go to the analysis of the subsidiary. And we did go down, we did not see any other transaction with Zahara. So that was it. Now we also need to check, was our goodwill impaired? That's the next question. So we're going to check if there was impairment on goodwill. Right, so go down again, going down, coming up. We go down, coming up. Right, we don't see anything. We don't talk about impairment, so goodwill was not impaired. Therefore, we can be confident to now say that these are everything that affects our profit, and we can calculate our total adjusted profit from there. Okay. So this is what I was saying, guys. Because of the NCI, all you needed was this section. So if you don't have time in the exam, you left it 5 minutes, and you're asked to calculate consolidated profit or statement of profit and loss and other comprehensive income, the only part of calculation you need to do is the current year, because that's the profit that you will take there to the consolidated statement of profit and loss, right, for the NCI. So it's only this section. So if you are in a hurry, just do this section only and get the profit. Okay, right. And as you practice, you will find a lot of shortcuts for yourself. The more questions you do, the more you find questions for yourself, shortcuts for yourself. Right. So 1,572,233. That's minus 17,646 plus 4,764. So I'm getting 1,559,351. Okay, 1,559,351. Right, so that is the profit for the year. That's my profit for the year. And now I need to share the profit between the parent and the NCI. Right, so my parent has 60%. So I'm calculating 60% of my profit times 60. So that is 935,611. And then the NCI with 40%, it is 623,740. So that's the figure we're actually waiting for us to finish off the question that we're busy with. That was the figure we're waiting for. 623,740. So we'll come here to our calculation of my NCI. Let me put it on a different color. So the NCI portion was 623. So 623, 740. Come here, put 740. All right. So then we can now calculate the profit attributable to the parent. All right. So we take the 3,649,268 and then minus 623,740. So the profit attributable to the parent is 3,025,528. Okay, that is what we were busy with when we were busy with B. I think this was B, no? Yes, when you're busy with B. Right, that is what we needed to do. So we left out that other section because you wanted to use the analysis to get the figure and then come back to our calculation. All right, that is why we had left it out. So now we have completed our B. We can then go to the next one, which is after we have completed our B, we can go to the next one, which is C now. Okay, any question, guys? Right, so C says prepare only non-controlling, non-current assets and equity section of the consolidated statement of financial position of Spree Limited Group. Now, for us to do this, we'll also need the joint venture as well. So we finished this. This is fine, but we left out our dividends. Let's do the dividend as well. Dividend paid. Right, we also need to do the analysis of the joint venture so we can get the carrying amount of the investment in joint venture. All right, so we need to do that to be able to get that, and also the part that affect equity, like the since acquisition if they have. Right, let's finish off this one first, and then we get into that one. So the dividend paid was 665,520. So we'll come here and put our 65,520. Here, 65,520 times 60%. 60% of that would be 39,312. Then the 40% will be 26,208. Okay. So that's basically it. So that's my analysis of owner's equity of the subsidiary company, which was Zahara Limited. Okay, guys, can I have 1 minute? I'll be with you now. 1 minute, please. All right, guys, I'm back. Sorry about that. Right, let's go to where were we now? So we finished the analysis of owner's equity of Zahara, and we managed to also calculate our profit. We managed to calculate our profit after removing the NCI portion of the profit that we got in here. Where's that? So we calculated, so this was the profit. We had to calculate 40% of that. Then we took the 40%, removed it from the original profits that we had calculated. Right, then we got that. So now we want to do the analysis of owner's equity of the joint venture. All right, so we'll call this calculation number 3 so that we can finish off the question. Calculation number 3. So this time I want to do the analysis of owner's equity of, right, so this is Isabella Limited. Okay, so in this one we're applying the equity method because we are using the joint venture. All right, it is the joint venture, so we're applying the equity method. Right, we have here with us the carrying amount in there. So we have total, that is a total column at since. All right, this is for Spree Limited. All right, so we were told, I go back to my group structure, Spree Limited had 35% interest in Isabella. Right, so they have 35% interest in Isabella. Oh, guys, 1 minute, 1 minute. Okay, guys, yes, so let's continue. So we have 35% investments in the joint venture, right? 35% interest. So we're going to calculate using our 35%. Remember, this is the equity method that we're applying. It's not the same as the subsidiary, right? So the parent has 30%, 35%, and here this is the column where we calculate the carrying amount of the investment in the joint venture. So it's not like the subsidiary where we have the NCI. Here there is no NCI. We are the NCI. We are the NCI. Anyways, so let's go read the story and get our date also right, but we can get our date from the structure as well. So this was purchased in January 2022. The year begins in July 2022. So there are 3 periods. All right. Because this is January and the year starts in July. So it is 3 periods. Right. So we are sure of that, but let's go read. Let us go and read. Okay, the information of Isabella. It begins here, number 5. Okay, so number 5 tells us what it do. Let's go to number 6. Number 6, it says on January 2022, Spree Limited acquired 35% of the issued ordinary shares in Isabella. The purchase consideration was settled in cash on the same date. In terms of the contractual agreement with other 2 operators, Spree Limited exercises joint control over the economic activities of Isabella. The arrangement was appropriately classified as a joint venture in terms of IFRS 11 joint arrangement. At the acquisition date, the returned earnings of Isabella amounted to 745, right? This figure here, 495, and the market value of Isabella's shares was 2 Rand 52 per share. All the identifiable assets and liabilities of Isabella were fairly valued at the date of acquisition, except for, so we have this one, an adjustment, except for machinery, bottle sealing machine with a carrying amount of 24,000 at the acquisition date. The financial accountant of Isabella was unsure about the IFRS. Okay, we did this already, né? The one where we had to find our fair value ourselves. All right, so we used the most advantageous markets, and the one with the highest net assets, the net price was 36. So we use this, but to calculate the fair value, we do not include the transaction cost. I explained this in the previous class. So here's our fair value, and here is our carrying amounts. Okay, anyways, let's get working now. So we have with us at acquisition. We have the share capital. We have returned earnings. And we also had that adjustment, right? So let's first deal with this one. The return earning was given, so I'll take it from the information given here, number 6. So it was given, the return earning was given as 744,495. 744,495. Okay, 744,495. That is my return earnings. And then my share capital, I'm going to get this one from the trial balance. So I go back to the trial balance, share capital of Isabella, the last one. So Isabella, it was 225,000. 225,000. 225,000. All right. Then right, so we now have to deal with the adjustments. We have to deal with the adjustment now. So we go to the information here. So we're told that the machinery, and remember guys, machinery is supposed to be depreciated. So don't forget the depreciation on machinery, all right, going forward. So there was a revaluation surplus, so it's 39 and 24. Revaluation surplus. Valuation surplus on machinery. Okay, so 39,000 minus 24,000. Okay, that is our evaluation surplus. This will also have a tax effect. Right, so 39,000 minus 24,000. This will be 15,000. Okay, that's 15,000 is the revaluation surplus. We then take the 15,000 and multiply this by 27%. This will be 4,050,000. Okay. 4,000,000, sorry, 4,000. 4,050. I don't know where I'm getting the million from. All right. Anyways, so that is that. And I believe this was the only transactions that occurred at acquisition for the joint venture. Right. We're just gonna double check. So they just did they synced this with the fair value adjustments. All right. So with the fair value, they put the fair value for us to get the fair value on our own and then be able to, like IFRS 13, and then be able to compare the fair value with the carrying amount that we're given. Okay, so that is that. And then they went on to speak about depreciation. The machinery had an original estimated useful life of 4 years and a remaining useful life of 3 years at the date of acquisition. The machinery was classified as property, plant, and equipment under the cost model in the accounting records of Isabella. It is the accounting policy of Isabella Limited to recognize depreciation over the asset's estimated useful life on a straight line basis. It is the group's accounting policy to write off depreciation on its new machinery consistent with the tax allowance granted by the South African Revenue Service. Anyway, so the tax, remember, depreciation, remember, it has to be over time. Eh? So at this point in time, we can't calculate depreciation now. Time has to pass. So we'll do that on the next period. But don't forget it. Okay. Right. So those are everything that happens at acquisition. At this point in time, we are going to total it and calculate our portion, our 35% portion. Right. So it's 225,000 plus 7,445,995 plus 15,000 minus 4,050. Minus 4,050, not 4 million. Eh? So it's 980,445. Okay. Now we have to calculate the 35% portion that the investor actually has, right? So 980,445 multiply by 35%. So this is going to give us 343,156. All right, that's basically, and then we are going to compare this with the amount that was paid on the investment. So we skip a line, and then we have now starting with investment in joint venture. Right, so let's go back to the information. How much was paid for the investment in joint venture? Okay, so we go back again to number 6 again. So they said on January is pre-acquired, blah 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 blah. Okay, at the acquisition date, the return earning was so much. The market, right? So they give us the market value of Isabella's shares was this. Right, we could use, this is one option, we could use this to calculate the price of how much was paid. Alternatively, we also go and check on the trial balance if it's not given. So just be careful, eh? If it's given, use it, because we want the one at cost. We want the cost price. That's the one we want. So we go here. But if not given at all, then that's the only option we have. Right, so investment in Isabella that's the one we're looking for, at cost price. That's correct. So the investment in Isabella at cost price is 310,250. 310,250. So we come here. Okay, so in here we've got 310,250. That's the amount given, and that's where we start our carrying amount calculation with the investment value. Right, we can see that the figure is actually lower than the equity receiving. So therefore, we're gonna have gain on bargain purchase. We're gonna have gain on bargain purchase. Right, the difference. So the difference between the two, 310, 250, is going to give us 39,906. 32. I don't know where I'm getting 9 from. 32, sorry guys. I'm seeing 32, but I'm writing 39. Let me just fix this. Please, can somebody also confirm this?
Yes, it's correct.
All right. Perfect. So that's our gain on bargain purchase. All right. The gain on bargain purchase is already a 35% figure. There's no need to come here. It's already a 35% figure. So we then take it, we continue from there. Right. I'm now on the next period. Remember, this was purchased in January 2022. Our year starts in July, so it's still after that. Ne? So don't be tricked because you see 2022, you think it's during the year. It's not during the year. Okay. Then we go to since acquisition. Guys, one thing about equity method is that with equity method, you should actually deal with accounts separate, like one-on-one. Deal with each account one-on-one. Okay, don't try to put them all together. Like you see the way we do with the subsidiary, I'll do the adjustments and then just share the total. When it comes to equity method, just do one by one. Everything must just be on its own. Right, so let's start with our retained earnings movements. So I'll just deal with retained earnings on its own. Okay, right. So my retained earnings, we have to get to the retained earnings at the beginning of the year, and retained earnings minus the one, retained earning at the beginning of the year minus the one at acquisition. So we go back to the trial balance. My trial balance, this is where I'm going to get my retained earnings at the beginning of the year. So retained earnings at the beginning of the year, this is my figure. Right, so it's 1,063,565. 1,063,565 minus the one at acquisition, which was 744,495. Okay, so that is that, and then we're gonna get our movements. Right, we're now gonna get our movement. So let's calculate that. So 1,063,565 minus 7,444,95. So the difference or other our movement is 319,070. Okay, so you deal with everything individually. So I'm gonna take that one and multiply by 35 straight. So I have 1,116,765. 1,116,765. Okay, this is increasing my carrying amount of the investments. Don't forget this gain on bargain purchase. It has to be reversed on the next period. So we have here gain on bargain purchase. Right, so we reverse this. This is already a 35% figure. So I'll take it there straight. This also increases my investment in joint venture. Right, so remember we say everything deal with them on their own. Then we have here with us, remember this revaluation surplus we had with us, it was of a depreciable asset. So we must not forget to account for the depreciation. But now it's now a game of dates now. It's now a game of dates. So we have here January 2022, right? That was the acquisition date. And we say there were remaining 3 years. 3 years remaining. Right. So from that date up until the beginning of this year, the year starts in July. So from 1 January 2022 up until June 22, basically. Then we're gonna have another June 23. Okay, so it's actually just a year. So in there, this is my since, this is my current year. Very important to do this, all right? So this is my current year, 1 July 22. Right, so then it means in my since period, I have January, February, March, April, May, June, 6 months. And in my current year here, I've got a full year, 12 months. Okay, so it's very important, guys, play your dates right. I can always call it the date game. Know your dates, otherwise you're not going to get your answer right. Okay, so the depreciation is on revaluation surplus. Please, it's not the full amount, it's on revaluation surplus. So depreciation on revaluation surplus, not the full amount, right? So it is 15,000 over the 3 remaining useful life times 6 divided by 12. I've just showed you why I'm saying times 6 divided by 12, because this is the since acquisition period. This will be the current year. All right, so we calculate that. Don't forget, this is going to have its own tax effect as well. So you're going to have to calculate the tax effect that comes with that too. All right, so 15,000 divided by 3 times 6 divided by 12. So this is 2,500. That's the depreciation. This is additional depreciation, so it's an expense, right? It's additional depreciation. It's an expense on our side, and therefore we have to put it in brackets. Then the tax effects. The tax effects on the other hand, we take the 2.5 multiplied by 27%. This one is going to be added, opposite effect. Right. The same effect will also affect our investments carrying amount. So we take the 2.5 multiplied by 35. That will be 875. So is here. This is affecting the assets, right? And the assets are under the investment in joint venture. Right, 675 times 35%. So this is 236. Right, the revaluation surplus effect, the net effects, net after tax effect. Right, hence we are doing it like that. All right, then do we have any other transaction that happened in there? Let's go read the information. Now my laptop. Okay, it's moving now. It was not working. Right, so let's read the information we have. Okay, so we read number 6. So we now have to read number 7. So during the current year, already is talking about the current year. So this does not fall in the since acquisition period. Right, so I believe this is everything that happened since acquisition. Guys, can I have 1 minute? I'll be back. Hey, sorry guys. Sorry guys. I was just sorting out something. I'm back. I'm back now. Let us finish our question. Sorry about that. Okay, I'm back. Let's continue. So we are still busy with the analysis of owner's equity of Isabella Limited. We're still busy with Isabella, and we will continue from there. All right. So we did the since acquisition, and we looked at all the transactions. We didn't have any other transaction on since acquisition. So we get into the current year. Right. It's now the current year that we are looking at. In the current year, we first of all want to see how is our profit affected on this. How is profit affected? So we work on that. Right. So profit for the year. Profit for the year, which is obviously it's the share of profit and so forth and so forth. Right. So here we go to the trial balance. The profit, remember our profit was given. It was given. So let me just erase this so I can see this figure very well. So the figure that we're given for our joint venture is 1,136,000 and 1,136,902. 1,136,902. 11 actually here 1,136,902 because you're still going to share it there anyways. Right, so you deal with the account separate. Every account you deal with them separately. Don't put them together. Deal with each separately. Remember, it is equity method. If it was a subsidiary, we would have adjusted the profit and then calculate together. All right, after adjusting. Okay. So now we have our profit in here. We're going to calculate 35% of our profit. 1,136,902 multiplied by 35%. All right, so this is giving us 397,916. Okay, so that's the one that is added to the profits. I mean the investment value. That is how much we add to our investment value. Then again, guys, don't forget this depreciation. I think it's just looking at us, so you must not forget it. It's calling us and saying, don't forget me, don't forget me. Right. So depreciation on revaluation surplus. Okay, this time around it is full year, so 15,000 over 3. Right, if you say multiply by 12 over 12, it's just the same thing, right? So come here, 15,000 divided by 3, that will be 5,000. Okay. This 5,000, we calculate our portion, our 35% portion, which is 1,750 and 1,750. It decreases our investment in joint venture. And this item is also going to have a tax effect on it. It's going to have a tax effect. All right, so we'll take the 5,000 and we multiply it by 27%. 5,000 times 27%. This is going to give us 1,350. This 1,350, we calculate 35% of that. It's going to give us 478. Right, 478. Okay, so we did see an intragroup transaction, which we said it was only for current year. So let's go back to that intragroup transaction that we saw, that we read together, number 7. Right. Number 7, it says, during the current year, Isabella sold. It's Isabella that is selling, right? So it is the profit that is affected. Therefore, it's going to affect the share of profit of joint venture and not the investment in joint venture. It does not affect investment in joint venture because it is the profit that is affected here. They are the one making the profits. Okay, so the profit goes to share of profit of joint venture. Remember, all income and expenses goes to the one line item, share of profit of joint venture. And everything asset and liability goes to the line item of investment in a joint venture, right? So it says here, during the year, Isabella sold selected fine fragrances and beauty products amounting to 118,000 to Spree Limited. Isabella sells inventory to Spree Limited at a profit markup of 30% on cost price. And on the 30th of June 2023, Spree Limited had inventory valued at 85,000 on hand, which was purchased from Isabella. So 85,000 is our closing balance. That's the one we're going to use to calculate our unrealized profit. All right. So it is 85,000 and is sold at 30% on cost. So we're going to come here and calculate our unrealized profit. Unrealized profit and closing inventory. Okay, so we did say 85,000 times 30 over 130. 85,000 times 30 over 130. So this is going to be 19,615. It is unrealized profit. We calculate 35% of this, and it is 66865. This does not affect the investment in a joint venture. I think that's what I was trying to explain, because this affects the share of profit directly. Okay, this adjustment will also have a tax effect. So we'll take the figure 19,615 multiplied by 27%. 19,615 multiplied by 27%. This is going to give us 5,296. 5,296, and if you calculate 35% of that, that is 1,854. Okay, these are the elements that affect the share of profit of a joint venture. All right, so that's basically it. That was that transaction that we dealt with the transaction. Guys, do not forget your dividends. I always say, do not forget dividends. Dividends is not always in your face, but you need to look out. Did we give dividends or not? Right, so we're going to check out dividends. Dividend paid. Right, we go to our trial balance to get our dividend paid. Right, in our trial balance, dividend paid 30 June for Isabella, it's 42,680. Come here, we put 42,680. Okay. So this figure will then calculate our portion. From the 42,680, we calculate our portion, which is the 35%, and this is going to give us 14,938. And we have here as well 14,938. Okay, so that's what's up, and that's it. Then we are done. So we need the total. We need the total here. The total, that is what we're going to get for our investment in joint venture total. So we're going to start from here. Right, so it's going to be 310,250 plus 675 plus 32,906 minus 875 and plus 236. Then we skip. We come here. Plus 397,916 minus 1.7 plus 478 and minus 14,938. So I'm getting 835,948. Please, can somebody confirm this figure? Because this is going to be very important as we're going to take this to our statement of financial position. Can somebody confirm this, please? Somebody confirm the figure? Guys, are you here? Are you still here, guys? All right, I'll continue. Anyways, the silence.
I'm still calculating. Someone
Okay.
else please confirm.
All right, so long, I'll continue.
It's correct.
It's correct. All right. Thank you. Okay, so those were the calculations. These are the major calculations that needs to be done. The required section itself is not a lot, but the calculations were really necessary for us to be able to do the required sections. So then we go to C. Right, we go to C. So in C, we're told to do prepare only the non-current assets and the equity section of the consolidated statement of financial position of Spree Limited Group as at 30 June 2023. So we want to answer that. This is for Spree Limited Group. Right, consolidated statement of financial position as at 30 June 2023. Okay, now in the consolidated statement of financial position, we don't want everything. We only want non-current assets and equity. So on my asset section, I only want non-current assets. Okay, so in my non-current assets, what can I find in my non-current assets? I can find property, plants, and equipment. Let me just say PPE because of space. I can find property, plants, and equipment. I can find investment in other equity instruments. Investment in equity instruments. Actually, we had debt instrument this time around. Anyways, we can find goodwill. We can also find deferred tax, and we can find investments in joint venture. Investment in joint venture. All right, so basically we can start from there and then we grow it up as we go. All right, if there's anything else, we'll look for it and find it. Okay, so let's start. I think the easiest one right now is the joint venture, the one we just calculated now. So it's the 835. That's the easiest one we can get, the 835,849. So we'll take that one, 835,849, 848. Okay, right. I hope we edited everything fine, but anyways, you guys can edit in your own time as well. Principal is the most important, so we go there. That is it, investment in joint venture. That's the easiest we can get. Another easiest we can get is the goodwill. We already did the goodwill calculation, so we can just come here and get the goodwill. It was 155,176. 155,176. Okay, this was done. I think this was calculation 2. And please, guys, get used to cross-referencing your calculations. Okay, get used to that. Then we continue. Right, so we have our investment in joint venture. We have our goodwill. Okay, investment in equity instruments as well. I think we did this calculation already. So we have to go back. I think we have to go back to question 1. Was it question 1? No, it was this one. We did this L on top here. It's amortized cost, whatnot, whatnot. We needed the one at 2020, the long-term portion, 2023. Okay, now I can't see it, but I remember doing this calculation. Okay, it should be this figure. Right, so the one we did in A, but now it's just looking weird. Okay, we can also apply we could also do the calculation on what you call calculator. We can also apply the calculator just to make sure we have the correct figure. All right, that's another way to do it. And remember, we want the long-term portion. We want the long-term portion. And when you are showing your loans or anything like that, leases of assets or whatever it is, you have to show the long-term portion and the short-term portion. So the long-term portion is usually what is the balance in the next financial period. So currently our year ends in 30 June 2023. It's the 30 June 2024 balance that we're interested in. That is the one. All right. And then from there, you can be able to get the short-term portion. All right. So there are different ways we can do this. I'm just trying to see what is the fastest way. Trying to see what is the fastest way we can do this. So we had already our 30 June. Let me start from there. 30 June. That's why it's always good just do the amortization for you to be safe. Because now we are here, we're trying to come back to the question that we did, and there's a lot in it now. Okay. So we're trying to come back and there's a lot in it. So let's go back to 30 June 2023. How much did we have in 30 June 2023? Okay. So from this one, so what did we say? Let me just go back to this one. Right, we had that value and then we had this one. Okay, we had also loss allowance. All right, now I see why it's different. So this one is different with that one because we had a loss allowance that we also accounted for. All right, so this should be this is the value. Okay, this is the value. It has the loss allowance as well. That's the one at 30 June 2023. All right, that is our balance by that time. We could have just taken that balance as it is, but they want us to separate the long-term portion and the current portion. All right. So let us do the calculation. How do we get here now? Let's think. I'm trying to see the fastest route to this. Right, and we didn't do the amortization at all. Running away from amortization is catching up with us now. Okay, I think I'm just gonna do the amortization so it can simplify matters for us. Yeah, let me do the amortization so we can simplify matters, and also the fact that we're having also loss allowance and all those stories. So I'm gonna do a short amortization table for us here. All right, please be with me. You want to get the correct results. Here with me. Let me do a short amortization table quickly. Right, balance. Capital or principal. I prefer to use capital. That's the one that's always over in my head. And then interest. And then we have installments. Okay, sometimes trying to shortcuts, taking shortcuts sometimes will catch up with you. And this is one of the time that is catching up. Right, February 2023. That's when we started, right? we had calculated our present value. Our present value was, where's my present? 1145,000. That was my beginning, 1145,000. Okay, and then our year ended on 30 June 23. Our year ended in 30 June 2023. And while our payment was supposed to be made in January, I remember very well. Payment was made to be paid in, yeah, there is it. Payment should be made in January, 31st January. We started already in February, so January is only in the next year. All right. So on this, let me put this one in red to say this is year end. 30 June 2023, that is my year end. In there, we're supposed to have calculated interest. So our interest value was given at, we had to calculate that one. It was 6%.0672. So 6.0672%. All right. And then with that, we then take that figure, multiply by 1145 000. Right, and I'm getting 69,469. So that was my first interest. All right, so that then we have to multiply this by. So February, right, February, March, April, May, June, 5 months. So that I multiply by 5, divide by 12. So I'm getting 28,946. So my interest, there was no installment. It does not affect the year. So 28,946. Right, that is then added because we are closing our books. We want to know how is this balance looking like. For reporting sake, we add. So it's 173,946. Let me write that properly. 1,173,946. Okay, then we get to the actual payments on the 31st of January 2024. Right, we want to get, so we'll do that, and then we want to end up on 30 June 24. That is where we want to end. Right. So to calculate this interest, so now we made our installments, and our installment value was 114,000. 114,000. That was my installment value. Then I'm going to have to calculate now interest from June up until January. So it's July, August, September, October, November, December, January. All right, so it's 7 months. Okay, so 7 must give 12. Yes, that's correct. So it's 7 months. I go back to this value, 1,145,000. 1,145,000. We take that figure, multiply by 0.060672, multiply by 7, divide by 12. So this is giving me interest of 40,524. 40,524. All right. Then to get my capital, we have to add these together, minus it from installment to get capital. So 40,524, which is 7 months interest, plus 28,946. That's minus 114,000. So this is giving us 44,530. Okay, this will then bring this value down. All right, so plus 1,145,000. This becomes 1,100,46, actually 470. Okay, that becomes the next balance. Right, and then we are back again on the 30th of June where the no installment is made. Right, I think at that point we are done because that is what we are looking for. Okay, then the interest now it becomes on the new figure, this figure multiplied by 6.0672%. Right, and this is the 6 months again. So it's, 5 months again. This is another 5 months. So it is February up until June is another 5 months times 5 divided by 12. So my interest is 27,820. Right, 820. This is all affected, so it's going to be added on that plus 1100,470. So my closing amount is actually 1128. Let me write this properly. So it is 112,829. Okay, this is at 30 June 2024. Right, so that is what we have at 30 June 2024 according to the according to the amortization table. All right, so we did that according to the amortization table. So now we want to know what will be our value at 30 June 2024. Now we would have taken the value as is. However, the issue is that it had allowance. It had allowance, all right, expected credit loss allowance, which we also had to take into account when calculating this value. We did that calculation, and remember here where we included the loss allowance. Let me just go back to the loss allowance calculation. We did the loss allowance calculation in here for 30 June 2023, where we calculated this figure as well as its movements. All right, so we're going to use those figures now to get what the value is. Okay, I hope you guys are understanding why. Ne? So it's because there is loss allowance. That is why we are not going to just take the figure as it was. All right, so then the figure has now changed. The figure has now changed, and we have to also account for the loss allowance. So what we can do is that we can calculate here. Let me go here. So we understand this is the long-term portion. This is the long-term portion. All right, this is the current balance. So these two, right? This was 2023. This is 2020. This is 2023. This is 2024. All right. So we can find the difference between that, which will be the short-term portion. We can work with the short-term portion. It is easier to work with. Short-term portion. Guys, this is just us applying our mind. Ne? I'm sure to you, some of you, it may look like, oh, what is Naomi doing? Is it new? It's not new. It's everything you know, but the way that it's put to us, we just have to use our brain to get the solution. All right. So we'll have to use our brain to get the solution. Okay, so the difference between these two, 128 what not what and 117 will be the short-term portion. So I'm just going to calculate that. So 1128289 actually it's supposed to be 90 to 90. Right, that's minus this 117. 117. Is it 3 now? Is it 3 or 5? 117, I think it's 3. Yeah, it's 3. 1973946. Right, so this short-term portion is 45. I'm going to go around it again. It's 45,656. So that's my short-term portion. Okay. Why am I doing this? If I get the current balance and if I get the current balance and add, is it add or minus? If I get the current balance and minus the current portion, it gives me the long-term portion, which I'm interested in, isn't it? So these figures, all of them do not have loss allowance, but this, the one we calculated here has a loss allowance, which was the current portion. So this was the current value, including loss allowance. Right. So I have that. What I can do now is to say, I'll take this figure here, the 1.1, so to calculate the long-term portion, I'm going to do it this way. I'll take this figure, 1126988. Right, that is the figure that we have, including the loss allowance. Then I'm going to minus the short-term portion. I want to get to this one. I want this one to also have loss allowance. Now, it is easier to work with the short-term portion than to go here because there'll be a lot of complications again, minus that. So we take that 456, that difference, 45656. I'm going to minus it, 45656, and then in there I'm calculating the 4%. That movement is already done, the effect of the movement that we had. Let me show you guys again what I'm talking about with my loss allowance calculation. Remember, the effect of the movement is already accounted for because I have already done the movement here. This is more like the movement. So then I'll just multiply this by the 4%. All right. And the 4% of the loss allowance already, I would have, actually it has to be minused from 45656 minus this. So then that whole movement, where am I? Hope I'm not confusing me. Minus that, so 45656 multiplied by 4%. Multiply by 4%, which gives me 1826. And then multiply this by 45656. So I get 43,830. All right. And from there, I can now get my closing balance. So I get my total 1126988 minus 43,830. This gives me now a total of 1,083,158. All right, so I know I did a lot of things. Let me now explain what I'm doing. Let me explain it again. Right, so the issue was, again, I'm going to say this again. If this question did not have loss allowance, right, I was going to simply go and take this value. That would have been the amount I'm looking for. But the fact that it had a loss allowance, and you can see the periods are not the same, it's payments are made in January, our year ends in June, and all of those things. So we did the calculation. If we go back to the previous class, we managed to calculate at 30 June 2023, we managed to calculate the loss allowance on that period, right? So we did the loss allowance on that period, 30 June. We did the one at when the commencement of the instrument started, the investment started. We did that. We did also the one at 30 June and the movements, all right? And it affected our balance. Okay, so this calculation, we had done this calculation together. Right, so that one is done. Then, now when we get to the current one here, the one we have now, we want to know also how much loss allowance also affected this. Okay, so to deal with the loss allowance, it's better to work with the movement, because loss allowance, we continue to work on movement. So when I calculate the loss allowance of last year and of maybe last year, this year, I have to minus the one that was accounted for last year. Next year, again, I have to minus the one that was accounted. So it's movement situation, right? So to do that easily, it is better I do it from using the current portion, which is the movement between the balance now and the balance next year. All right, so this is my long-term portion and my now balance. This is my movement, is my short-term portion. I can just use that short-term portion to calculate my loss allowance of the 4%. All right, that is why I had here in the big bracket. I will calculate this is the allowance. This is the allowance, loss allowance, minus it from the actual value. It gives us an amount after. This is the amount after loss allowance is accounted for. And the loss allowance was the movement, hence I've used this figure. Right, so when I come here now, I can then take the portion that I had, which also includes loss allowance, minus this to get the long-term portion. Okay, to get the long-term portion, which is the 2024 figure. Right, any question here? Any question on this one that I just did now? Okay, guys, think about it. Give me 1 minute also. I'll be back.
Guys, is it me or the audio has been off for some time?
Yes, sorry guys. Yo, my day is something else, and I really apologize, guys. I'm being on and off in this class. Oh, I hope we're going to flow now. Yeah, I'm trying to do many things at the same time. Sorry about that, guys. Okay, so I did ask a question before I left. Do you guys have any question with the calculation that I just did now? Do you all understand how I got the long-term portion? I think that was my last question before I had left. Any question? Okay, I'm going to continue. So the figure we got is 1,083,158. So we have to go back to our statement of financial position. Now, statement of financial position and put the figure. So investments, it was in debentures. Was it debentures? Let me just confirm. Spring limit investments. Okay, bonds. Yes, it was investment in bonds at amortized cost. Investments. Investments in bonds at amortized cost. Okay, so the value was the value that we got there, 1,028,000, 1,028,000 and 158. 1,028,158. Okay, so we're almost finishing with this question. 1,158. Right, so that one is there. We didn't have equity instruments. We did goodwill. Deferred tax is usually the movement, but mostly if they want deferred tax to be in the question, they've also mentioned that include deferred tax, because deferred tax can be either in asset or liability, right? So the question didn't ask us to include it. All right, so we might as well just leave it out. And then the PPE, property, plant, and equipment, that is the major part of this question. That's the major part of this question. So we first of all start by combining, and after combining, we then look at the intergroup transactions that we had on the PPE, the property, plant, and equipment notes. All right, so we have with us here, we go back here, property, plant, and equipment is already at carrying amount. Guys, very important, it must be at carrying amount. We cannot get PPE at cost. If it's at cost, it means you have to calculate the accumulated depreciation as well. You have to also include the accumulated depreciation. Otherwise, and I'm getting disturbed, calls, whatnot, guys. Sorry. I wish I could put my things off, but everything has to be on because I'm using them. So please forgive all this noise that is happening in between. And I know Zoom usually also hides noise. I hope you guys are not listening to the noise in here. Okay. Anyways, so like I'm saying, the PPE has to be at carrying amount. If it's given at cost, you have to make sure you bring in the accumulated depreciation so that it is at carrying amounts. All right, so basically that's how it works. So we're going to get our PPE of the parent, 100% of the parent, 100% of the subsidiary, and the Isabella, you take nothing because it's joint venture. All right. So in my PPE section, I have 1,487,000 428 38 438. All right, so that's the first one I get, 438. So let's go and do this. 1,487,438. 1,487,438. This plus plus 1,814 and 74. 1,814 and 74. 1,814 and 74. Okay. Right. So that's that. And then we continue now. We are going to now look for the intra-group transactions that affected our PPE. Okay. So I remember the parents sold some machinery somewhere. We did that calculation when we were calculating the PPE. And when we were calculating the profit, sorry, when we were calculating the profit, I remember the parents had sold machinery somewhere there. Let's go look for that transaction. Yes, this is transaction number 4. Right, it says in January 2023, Spree Limited sold its machinery to Zahara. They sold it in January 2023, which is during the year. They sold it for 69,300 and the carrying amount was 550,120. We had done this calculation. I'm just trying to see where we had done it, but I remember us doing this calculation already. Might as well use it. It is not this one. It is the one on the sale of machine. There we go. So there's the value we had calculated. It was 19,180 and its tax effect, of course, is that. But we are not taking the tax effect. So the machine, 19,180. That is unrealized profit. So I'm going to go to my PPE. So we're going to say minus 19,180. Right. So we've gotten that calculation in A. Okay, just to do a little bit of a cross-reference. Right, so that was that. Another thing that affected our PPE. Now, remember, do not take this one, this revaluation surplus that was on the joint venture. Remember, this revaluation surplus was on the joint venture, all right? So it cannot affect our PPE because it's already part of the investment in joint venture. It's already part of the investment in joint venture, so it will not affect our PPE. All right, so don't take that. Then, as for the depreciation on that, let's also take the depreciation on that. So I'm going to go back to the same calculation where we actually got in that figure. Also the depreciation. All right, so the depreciation on unrealized profit was 2,740. 2,740, we're going to take that one. That is going to be added on the PPE. So we're going to say plus 2,740. Okay, like the revaluation surplus does not affect us, is already included in the investment in joint venture. So basically, this is it on my PPE. I can close my PPE to get my property, plants, and equipment total. So 1,487,438 plus 1,814,074 minus 19,180 plus 2,740. Okay, so this is giving us 3,285 and 72. Okay, that's my PPE. I have my goodwill, my investment in joint venture, my investment in bonds. All right. So that seems to be all the figures that we have there. So we were told also to do the equity. All right. Also the equity section as well. So in my equity section, I'm just going to list them. We have share capital at the end. So we are looking at this equity at the end of the year, not just in between, at the end of the year. So we have share capital, we have retained earnings. If there was maybe adjustments to revaluation this year, we would have also included it there. We do not have. Okay, the revaluation happened at acquisition that time, right? And then non-controlling interests. Right, so share capital is always the easiest because share capital is just the figure, the parent value only. So we go to our trial balance, we check on the parent side of things, parents on our trial balance, the share capital of the parent, it is 600,000. So that becomes my value for my equity, 600,000 share capital. Right, that is always the easiest, 600,000. Well, the return earning is the one where we always have to do calculation, eh? Return earning is always the one way calculation must be done almost all the time. All the time, it's always the return earnings that has to do calculations, because first of all, the balance of the return earning is already a calculation on its own. Then we have to look at so it's the balance. Then we have to look at if there was a intra-group transaction that affected the parents directly. It also has to come here. And then we have to add the profit for the year and the dividends. Okay. So anyways, I'm going to just do this so I can do my calculations properly on the side. Let me start with my non-controlling interest. I believe that one is not a problem. All right. So non-controlling interest, I can even do my calculation from here. I can even get my value here of my non-controlling interest, okay? Because I have my column already there. So my non-controlling interest starting from 592, so I can just get it from here, 592,000 plus 391, 367 plus 623,740, and then minus 26208, right? Which is gonna give me 158. So it is 1,580,000, 1,580,000 and 899. All right, so I just added that column from there, the total column from the analysis of owner's equity. Thereby, it has simplified the matters for us instead of having to recalculate. Remember what makes up your non-controlling interest? It is basically the opening balance, which is at acquisition plus sales. Then it is the profit for the year, which you also get from the analysis, and it is less the dividend. So at the end of the day, that's the figure that we actually get. Right, so I'm going to go there and put my non-controlling interest. So it's simplified my life that way. I have 1,580,899. Right, so this leaves us with return earnings, okay? So return earnings, I want to first calculate return earnings opening balance. I want to calculate my opening balance before anything else. Right, so the opening balance is we take the return earning of the parent first. We take the parent's return earnings. Return earnings of the parent, there we go. 3,046,516. 3,046,516. Right, plus we take the return earnings since acquisition of the parents. The portion of the parent since acquisition, 587,050. 587,050. And then we take also the one for the joint venture since acquisition, even that as well. All right, the return earnings, joint venture since acquisition. It also does affect us. All right, 1167, 11676, 111. Okay, 111,676. Okay, that is basically opening balance. That is basically return earnings, opening balance. All right. And then once we have our return earning opening balance, and we have to now look at intra-group transactions that must have happened from the parent side, especially when it is the parent who actually incurred the intragroup transaction. Oh, also don't forget also even the gain on bargain purchase, even the gain on bargain purchase as well. This 32,906 must also be included. 32,906, the gain on bargain purchase of the this was of the joint venture. So this is the joint venture, this is the sub parents portion, and this is the parents. All right. So at acquisition, that's what happened. And do we have anything that the parent did since acquisition? So I remember this transaction that the parent sold, it was actually affected the current year, did not affect its acquisition. Right, it was in number 6. Number 6, it was on 1 January, Spree Limited. So Spree Limited sold during the year, not since acquisition. All right, so because it's not since acquisition, then we are sorted. So our figure that makes up our opening balance will be the parent's opening balance. It will be the subsidiary opening balance, which we get in our analysis since acquisition. Then it will be the joint venture portion as well since acquisition. It's only the return earnings that we're looking at, and the, of course, gain on bargain purchase that occurred in there. All right. So that's about it. So that makes up my opening balance. So that I'll get my opening balance there. So it is 3,046,516 plus 587.50 plus 111,676 plus 32,906. So it's 3,778,148. That is my opening balance. Right, so I'll just come here and open here to say this is my opening balance, 3,778,148. Then this plus the profits parent portion, the one we calculated, the parent portion. Right, so we'll come and get our profits parent portion. It was 3,025,528. So we bring the parents portion in here plus 3,025,528. Then we're going to minus the dividend, and the dividend is only the parents' dividend. Only the parents' dividend. So we come here, dividend paid 156,600. 156,600. Okay, 156,600. That is our dividend, and then we can get our return earnings total from there. Okay, right. So 3,778,148 plus 3,025,528 minus 156,600. So this is going to give us 6,647,76. All right, guys. So that's what we had to do. I think that's what this takes us to the end of this question. So we managed to do C as well, right? I think we have really done quite a number of questions with groups by now. So we are left with an hour, I think, and some few minutes. So I want us to ask, guys, if you have questions, please just feel free while you are studying. What were your challenges? Let's talk about it. Let's see how best we can help you. Yeah, so let's do that. Please bring your questions. You can ask questions on this question or on any other question that you worked on, which you found to be challenging. So I'm just leaving space for that. Any questions from you guys' side? What is your main challenge? Let's also talk about that. What is your main challenge? What is really giving you a headache, which you feel like if it has to come on Wednesday, you are not going to perform well? Let's talk about that. What's your main headache? Let's talk, guys. You're too quiet. You're too quiet. Are you guys exhausted?
No, we are not.
Yeah. You've been studying, I believe, right? So I actually feel like you guys should have a lot of questions. Or are you guys not studying enough? Or is everything
No, we are
perfect? You're
studying.
perfect.
No, you're not in accounting.
Okay, so what is the problems? What are the problems? What are your challenges?
People are quiet. I don't know why they are always quiet. Maybe they're scared. I don't know. They're scared of who. But can we at least find a question? Actually, it's not a question. I wish like you can go back to leases and tell us how to account the manufacturer and also
Okay,
the general lease.
all right.
The main difference because of sometimes we are confusing things. I I wish you can touch this adaptation step 4. There is a lead. Is it or mock exam?
You're breaking there. I don't know if it's me or it's you. I'm not so
Clive,
sure. But I can't hear you well.
can you hear me now?
Yeah, now I can hear you.
Yeah, there is this other question in, I think it's mock exam, 2024 mock exam. You have the paper.
No. Is mock exam not directly in your...
No, it's a paper like we can download it. It's more like a question paper.
Oh, no, I don't have those ones.
Okay, let me share it in the group.
Okay. Thank you. So you said your issues are on leases, ne? So you want me to direct you on leases.
Yes,
I could hear that part. So you want me to direct you on
yeah,
leases for you to know the difference between when it is a manufacturing, whatnot, ne?
yes.
Basically, ne? Okay. All right, no problem. Okay, let's start with that one first.
Yes, I just shared the paper.
You shared the paper. Okay. All right, thank you for sharing the paper. I want to see if I find things on leases, but this is a question. I'm just trying to find also my notes that will help you guys on leases. And I think leases has always been an issue to most students, eh? But leases also, it's also that topic that if you catch it, you are sorted. If you catch leases, it's also another one because if they test it, they really comes with marks, eh? So I'm just trying to get the way I did a summary. I know I did a summary on that, and this summary will help you guys big time. That's when I found it. I lost it again. There we go. All right. Okay. Right. I think it's this table that I want to talk about the most. Right. Okay, guys. So first thing first, you have to be able to differentiate between a finance lease and an operating lease. I think that one is not much of an issue, right? Right. With the finance lease, we do know that the finance lease will have it's when if ownership is transferred, it can only happen with a finance lease. Ownership can never be transferred with an operating lease. But that does not mean that Just because ownership is not transferred does not automatically mean that it's not a finance lease. It can also be a finance lease, but ownership is not transferred. I'm sure we know about that, right? Okay. 1 minute. Okay, so let's, like I was saying, so basically you need to know the difference between finance and operating lease. Then secondly, we go to the finance lease. The finance lease is the one with the marks, né? That's the one that brings a lot of marks. So for us to know if it's a normal lessor, a general lessor, and a manufacturer dealer lessor, we have to go to the nature. I think I did an example here. We have to go to the nature of the business. What does the business do? All right. So you need to ask yourself the question, what does the business do? What are they selling? If, for example, this business sells machine, if they sell and make machine, it's no longer a normal lessor. It becomes a manufacturer or a dealer lessor because that machine is not their PPE. So you always have to ask yourself the question, is this part of PPE or is this part of inventory? All right. If it is part of inventory, it is a manufacturer or dealer lessor. So if I make machine or I make equipment, they are all inventory. But if I don't make equipment, for example, I sell, like I said here, Pick and Pay makes groceries, homewares, clothing and stuff, and they decide to buy a machine, that machine is their PPE. Then it makes them a normal lessor. So whenever you're reading a list question, study the business, study the product that the business is doing. Is this product their property, plants, and equipment, or is this product their normal, like their inventory, their stock? Is it part of their stock or not? All right. So that is where you determine if it's a manufacturer or a dealer lessor. Now, once you pick up that aspect of it, then you can be able to now go further. Now we go to the table that I was talking about. What are the differences? All right. So if it is, I hope you guys can see. I'm trying to make it as big as possible. Yeah. So if then we say that this is a normal lessor, it means the PPE is the one that is affected. Of course, we both have net investment in the list, but it's the PPE affected. But if it's a manufacturer, the lessor is the inventory. That one is fine. Then when we have initial direct costs, for example, legal fees, commission paid, anything, any cost that is directly attributable to the lease contract. In other words, this cost could have been avoided if the contract was not there. All right. This kind of cost, if it's a normal lessor, as they are supposed to be capitalized to the present value of the lease. Okay. So under a normal lessor, I'll take such costs like your legal fees and stuff, which is incurred by the lessor. I'll take it and capitalize it to the present value of the lease. However, if it was a manufacturing or a dealer lessor, because of the nature of business, these are normal expenses. It's just me running my business. It's just another business expense. So it's just going to be expense. It's not a special expense. It is there. It is how I run. I'm running my business. You understand? Because it's my stock and I'm selling my stock. I sell my stock every time. So if I incurred initial direct costs, this initial direct cost will be, if I incur initial direct cost, this initial direct cost will be expense. It's just another expense. I'm going to take it as a legal fees, normal expense. Okay. Then with the interest, also, we need to also note the difference with the interest. With the interest, I need to note that with a normal lessor, I'll use the IRIL, interest rate implicit in the lease. That's the one that we always calculate, the interest rate implicit in the lease, right? It is used for both the normal lessor and the lessee. They both use interest rate implicit in the lease. And if it's not possible to calculate it, they will give you the incremental borrowing rate. Now you have to be very careful because they can give you different interest. I've seen a question where they just said interest rates, then they gave interest rate implicit, then they gave incremental borrowing rate, then they gave market related interest. So they can just give you different interest. You need to know which is used for what. So for a leasee and a normal lessor, you are supposed to use interest rate implicit in the lease. Unless if the question specifically says that it is not possible, it is impracticable to have interest rate implicit, only if they say so, then you will use the incremental borrowing rate. All right. As for a manufacturer or dealer lessor, for that one, you must use the market-related interest rates, which would be given to you most of the time. It's possible that you may also calculate it in the same way, but most of the time it will be given to you. Okay. And then when you have to calculate the market-related interest, you would have to use your present value would have to be your selling price. All right, it would have to be your selling price. Okay, but most of the time it is given. So you see the difference already. The asset that is affected for normal lessor is PPE. For manufacturer lessor is inventory. Initial direct cost for a normal lessor is capitalized. For a manufacturer or dealer lessor, it is expensed. Yeah? The interest used for a normal lessor is interest rate implicit. For a manufacturer or dealer lessor, it is the market-related interest. Okay. Then for depreciation, remember, because this is my stock, I'm not going to depreciate it. We believe it's still new. It's still in the plastics. You understand? So there's no depreciation on it. But for the normal lessor, will depreciate up until the lease commences. Because when the lease commences, it's as if, remember, finance this is more like I'm selling the asset. It's as if I've just sold the asset. So depreciation will no longer be on us, but it will be on the leasee side of things. Okay. But with tax allowance, on the other hand, tax only recognizes the legal owner. It only recognizes the person who owns the asset. Whatever lease contract you have, that's not their problem. As long as you're not yet the legal owner, you cannot deduct tax allowance. So with tax, it is still the lessor deducting tax, but with depreciation, it is the lessee calculating depreciation. Now, for my manufacturing or dealer lessor, no depreciation, no tax allowance. Remember, we still believe the asset is not put into use. The asset is not put into use. It's just being sold like that in plastics and all of that. Okay. So basically, those are the differences. Those are the major differences that you're looking for when dealing with, of course, these ones. I don't think you have issues with these. So those are the major differences that you are looking for, right? When you are dealing with that. So I'm going to go look at the question that you've asked, but is there something that that you're still confused with in terms of knowing the difference between manufacturer, lessor, and a normal lessor? Is it something you're still confused with?
No.
Okay,
No,
so it's just a matter of applying, eh? So it's just application now.
yes, I think your table it has a lot of information. It actually simplifies the difference between the leasee, lessor, normal lease, and manufacturer. And then again, I want to get this one correct of the leasee, of the
Okay.
right of use.
Okay.
The moment we become the leasee, the lessor will transfer the right of use asset to us, right? And then we will have the right of use asset. And then we will
Yes.
recognize it as a non-current asset.
Yes, that's right.
And then the lease liability will be those amounts, those installments that we are going to pay.
No, the lease liability
Or
is the balance. Is the balance.
or is the balance.
The
Actually, it's the
balance of the
contract.
lease.
Or the moment we debit the right of use asset, we credit the lease liability.
That's right. But remember
Okay.
now, we don't do just the balance. We deal with the interest and the payments, né? Because the interest is the expense and the payment is affect the bank. You see, the two of them, the effect of the interest and the bank payment is the auto effect on the balance. So it's like I'm showing my balance, but I'm splitting it between. I'm showing my balance, but I'm splitting the balance between what is it called? Payments, bank, and the interest. Okay. So that's how it's done.
Yes. Yes. Oh, okay. So the right of use will be affected by the payments. For example, if we make the payment, the first installment, obviously the right of use is
No, not the
the
right of use,
gross,
the lease liability. Lease liability.
the lease liability will be
Yes.
decreased.
Yes. That's right. Will be decreased.
Then what's the effect? How are we going to record this in the statement of financial position? We only record the right of use asset in non-current and also lease in non-current liability.
Okay, so you need to understand this name. The right of use asset is just like your PPE. Think of it exactly like property, plant, and equipment, right? So what it's doing is just accounting for
Yes.
depreciation. Do you understand? That's right of use. Right of use is simply your PPE, and PPE is decreased by depreciation. That's it. Unless if there was a remeasurement or lease modification or that. So your
I
right
think
of use is simply PPE. The lease liability is the one that is affected by the payment and the interest. Do you understand? That is the actual
you're
loan.
very
It's like
clear.
we are owing, isn't it? That's why it even says liability. That is the actual loan now. To say, okay, fine, I was owing you 1 million, but I paid you 100,000. So remove the 100,000. But then it says, yeah, but I'm still also charging you interest because time value of money, you can't keep my money for long. It's not going to be the same value anymore. So on top of the 1 million, I'm going to charge you 20,000 interest. You say, okay, fine, we increase 20,000, but I paid you 100, remove the 100. So we increase the interest, we remove the payment. We increase the interest until we come to the end, until we come to the zero balance, or if it has a residual value, we reach that residual value. So basically, that's what is happening.
No, it makes sense a lot.
Yeah, the lease liability is the loan. Yes?
Problem I was thinking that the lease payments that we're going to make will decrease the lease liability and also the right of use asset. Only
no.
to find out that the right of use asset is decreased by the depreciation. The moment we use the
Depreciation.
asset, we are depreciating.
Yes. Depreciation. The only time a payment affects right of use is if the payment was made before the lease commencement date. All right? Before let's say our lease started in June, but in March we made a payment. Do you understand? That payment will then affect the right of use. It will then be decreased from the right of use. All right? That's the only time. Any other payments from the lease, as long as the lease started, it's affecting the lease liability and not the right of use.
Okay, I think I'm covered. It's live. Was raising his hand.
Okay, Clive. Yes, Clive. Clive, you are muted, eh?
Yes, yeah, I can hear you. Kate, Naomi,
Yes.
yeah, I wanted to ask on the perspective of revenue with customers, ne? Especially on step number 1, whereby we need to identify the contract. There's this point whereby they speak about commercial substance. Can you clarify on the commercial substance? Like, what do they mean?
Please repeat your question.
No, I was saying I wanted to ask on the commercial substance, more especially on the first step of identifying a contract with customers on IFRS. I think it's IFRS 15 or 16.
15, yeah.
Revenue.
15. Identifying contract with customers.
Yeah, and there's this point whereby they speak about a commercial substance there. Can you please clarify it?
Okay. Just a minute. I'll be with you now. Sorry, guys. My mind is. I am so divided. My attention today. I'll be with you now. Just give me a minute. I'll be with you now. Yo, guys, I'm back again. Oh my God. Yo, my day. Okay. Clive, please repeat your question. Sorry, guys. I'm now focused. Please repeat your question, Clive. You're talking about revenue, I remember. Yes. Revenue, what happened?
What's wrong with my phone? Okay, I was asking like revenue, and I wanted to know about the commercial substance on the perspective of revenue, especially the first step where they say identify the contract with customers.
Okay. All
So
right. Okay. No, you can finish.
no, I was saying there's a point whereby they're saying it has to have a commercial substance. So I wanted a clarity on the commercial substance.
Okay. All right. So commercial substance actually refers to the like the future transactions, like if there's any change to the cash flow, right? If there's any change to the cash flow, um it should be as a result of the transaction, basically. So it's looking at time value of money as well. It's looking at time value of money into the transaction to say like when it is expected that the future cash flows of the business will change as a result of the transaction. Right. So it's mainly on the time value of money, if you have to put it like that. It's looking at the pattern of this transaction and its future effect on it. Okay. So that's what it's basically about. It equals the effect of time value of money on the transaction involved, like the transaction we are looking at. Okay.
All right, thank you.
All right. Cool. Any other question? Most of us have already left. They've left. They went to study. Most people are gone. Guys, it's funny, né? I ask questions. People don't. I give a chance
No,
to ask
they
questions. People don't ask. And then when they go in the exam,
no,
they don't.
they went to sleep. Can you open that mock exam? I just want to
Let's
so that
see.
you can navigate exactly to the least part.
All right. Let me edit here. Where did I put it? Okay, there it is. But isn't this?
Yeah.
Didn't we do this?
Yes, it's part of the study pack, and then also the assessment 9 that we're doing. Some of the question, especially this question A and B and C.
We did this.
It
Didn't we
was
do this on the day I came there on Friday? Or am I confusing this? Matetiele? Or was this before? We did this. Okay, yeah, ask the question.
Kalkfontein.
It's
It's
fine.
what it was Matatiele. It's the one that I'm looking at.
Yes. Hey, you're breaking, huh?
Yeah, at Kalkfontein, that one of Kalkfontein.
Manufacturing plants in Fontaine. Yes, what about it? I think we did this.
Yes, I think
Was it this not? Did I do this with you guys on Friday or did we do this in class? Because we did this question together with you guys.
maybe I was not there.
Yeah?
Maybe I was not there. Clive,
Guys, we did this together, man.
Yes,
we did this question in Kalkfontein with Naomi.
property. Yeah, I think we did this, if I'm not mistaken. Let me check the assignment.
Now what I remember is that we did this in Unisa.
You did it with we did it also to. I'm trying to also find it, eh? I'm also trying to find it. We did this together. No, this is, I went to the wrong one. Yeah, let me just look for it. We did this not even long ago. It's either we did it together when I came that side, or we did it on one of the revisions that we just did now. Yo, am I losing my things now? But now I don't know where it is. We did this, didn't we? I remember this question very well, and I remember you guys were all there. I was talking to you guys about it. Let's see. Oh well. I don't seem to find it, but I know we did this Matetiele question together. Clive, are you not finding it, Clive?
No, I can't find it, but I think remember maybe the question that we did. I remember. I think it was on groups, especially the way these two companies. It was clean and then the other one. So, but this one I don't remember we did property in material.
Yeah. I remember it very, like, let me go to the one that, let's just ask your question. Let me just go to the one that you are talking about, so you can just ask your question, eh? But I remember we did it not long. Now where did I put it? Now I even lost this one as well. Okay. Which one was it? Okay, I'll just create another one. Let me just bring it again. It's fine. Just do a new one and insert it. Matetiele, we did this one. Okay. All right, yes. Please ask your question. You said Fontaine.
Yes, I wanted to at least name and the part only. This one in manufacturing, analyze it and apply the other side. We are going to calculate this and that, and then we are going to decide the financial positions.
I didn't hear you well. You're breaking.
Nowadays, my network it's
Yo,
giving me
you talk like
tendency.
maybe 2 seconds, then you're off. You took another
It's
2 seconds.
it's giving me tendencies. It looks like now I'm living in informal settlement. Okay, if like we can go through this one only, this one of Matatiele, because of like, so that we can refresh our memory, especially on the least question. But
All right. This matter.
I'm sorry for taking you.
No, you have not done any wrong. Yeah, this Matetiele question, eh? Then it is the assessment 9, is it not? My goodness.
It's assessed.
It is because it was an operating list, remember. It's the assessment 9 that we're busy
It
with.
was operating.
It was an operating lease. Remember, there's an incremental, there's a yearly increase. It was an operating lease. Yeah, it's assessment 9. It's the one we're busy with. My goodness. No wonder it feels so new. Like it feels so like you. Yeah, you see what I'm talking about. Can you see it? Can you see it?
Let me
Can you see my
see.
screen?
You just finished it now, Miss. Oh,
You can see
when
the
was the
screen.
class? Is it today?
It was on
Yes, I
Saturday.
can.
The one we did on Saturday.
Mm.
Where were you, Katlego?
I mean, I don't remember properly now.
No wonder. I'm like, this is so fresh. Like, yo. When I saw the question, I'm like, no, but this is too fresh, Moose. You can watch the recording. I did this with the class. It was an operating.
Okay, I will go through the recording, especially on this part.
I think I understand what's confused you is the fact that they said Coros management decided to list out their manufacturing plants. That does not mean automatically it's a manufacturing lessor. Ne? And besides,
Yes.
yeah, it does not mean automatically. What exactly are they doing in the business? You have to check what is being done in the business. All right. And you have to know what is
Mm.
their stock. Just because they mention the word manufacturing does not mean automatic. Okay. And also here, when you look at the lease, the, the lease only has incremental, like they make monthly payment and it has a 10% increase. And then they mentioned here that at the inception of the lease, the present value of the lease payment does not amount to the fair value. So if the present value does not amount to the fair value, it's also not a finance lease. It has to be equal to the fair value.
Oh, yeah,
That's another
that
point.
principle. That
Yes.
principle, I thought maybe if like it is close, if like it is close to fair value,
Or
and
it is
then that's the final.
I think it is 80% or something like that. I think it is 80% of it. Right. So when you look at every indication on
Yeah.
this is you see that it is not a finance list, it's actually an operating list.
Mm.
And you
Yeah,
had
no.
so it's assessment 9. Yeah, they brought it as a mock exam. Oh, that's nice. They brought it as a mock exam. All right. Unisa is trying their best, guys. They're trying, eh? Please, you guys just need to study. I think you guys will do well. I think you do well. They gave you a lot of materials to work with. Although you are, are not really attending classes like everybody else, but they're giving you enough material. If you really sit to practice, then you should be
You're
good.
saying they're trying their best.
Yeah. With all these questions, study guide 1, 2, and 3, then they give you mock exams. Then there's past assessment. Guys,
If only you.
but guys, they're trying, Moose. You have enough material to pass to do very well. I believe so. If you're
Naomi,
using them. Yes.
Naomi, can I please quickly ask for a solid favor? Ne? There were notes
Okay.
that you opened now on the list. Can you please resend the entire note? My phone cleared,
The list. Okay. No
please.
problem. No problem. I will do that.
Yes, especially for that class.
Okay. No problem.
Thank you very much.
Right. Do we have questions? Okay, guys. So at this point in time, I think really you guys should just rest. Rest and then study again. Wake up to study. And as you are studying, if you have questions, please don't hesitate to ask. Okay. So keep asking as we are going. And yeah, your groups are too quiet for people that are writing on Wednesday. Like, ask your question, guys. Don't keep it inside and then go and struggle in the exam. It won't help, ne? Don't keep it inside to struggle. Just please ask questions, ask
Yes,
each
sir.
other, talk to each other, ask, yeah. Is that a question?
No.
All right, guys. Let me end the class then. I'm also tired and I'm still available. I think I will keep my phone on me just in case somebody needs my help. Please, yeah, just WhatsApp me. Don't call me. It's just WhatsApp. It's fine. I'll answer you. So I am gonna keep my phone with me. Anybody who needs help, anybody who has a question while you are practicing, maybe you are starting a new question and you're stuck or something, feel free to ask. Okay. So my phone is gonna be on. All right. Thank you guys for joining. And all the best for Wednesday, guys. Remember, confidence before everything. Eh? Trust yourself. Trust whatever you have studied. Don't panic at all. Don't allow anything to make you panic, because the more you panic in the exam, the more you will not be able to think. So what you need is confidence, né? Confidence. And please remember your admin work. Get the admin out of the way. Learn how to use IRS. Learn how to use Invigilator. Learn all those things. Whatever they want, learn now. Go and read those announcements. What is the lecturer saying about the exam? You need to read, guys. I've noticed that Unisa students don't like reading announcements. And then they will ask things they're supposed to know from us. Ne? Like, you guys are the one who has, like, you are the one registered, so you get more information. You read the announcements. What is the
It's
lecture?
called being a student. It's
Yeah,
called
thank
being a
you.
student.
But you guys, you have the announcement with you, but you want to know it from me who's not registered, like, so please
You
read.
are our tutor, so you must know. You are our tutor. You must know these
Kanjan,
things.
Kanjan, am I supposed to
You
be,
are our
how
tutor.
am I supposed to know the
How do you
announcement?
know? How do you know these things? You must know everything. You are our tutor.
Yo, my goodness. Guys, you are the registered one. You are the one who knows what the lecturer is saying. Like, you see, I wouldn't know that. I know the knowledge and every other thing. But as for the announcement of how the exam is going to be, what, you guys are the ones who's supposed to be informing us. So read every announcement, guys. Read every announcement. And also just check out your e-tutor. What is the e-tutor saying? All those things, just for you to be sure of, make sure you don't miss any information for the exam. And also have a look at those I think preparatory class that the lecturer does. Those classes, if you are listening carefully, they will tell you what's in the paper. Like, especially I've seen it with MAC with me. I'm talking from my past experience, that the class actually told us the paper. You understand? So you have to be that person who's listening well for you to pick up that these things is saying is what actually will come. So please also go and look at those recordings, check the announcements, be ready, know what is happening, guys. Eh? Please, you need to know the information around you, especially now that you're writing your final exam. You need to know the information. So don't just move like a blind person. No, go and read everything. Know everything. Know which systems you're using. Know which application you're using. Check your phone. Have plan Bs. If things go wrong, what do you have in place? If network goes wrong, if electricity goes off, what is your plan B? Please have your plan B already, you know. And yeah, all the best, guys. I believe in you. I know, guys, you have studied. I've seen you guys. You guys were my favorite class this year. And I love the way that you guys would go and do questions and come and ask questions. It was so challenging. It was so beautiful. So I really trust you guys. I really believe in you. And you need to believe in yourself as well. Have confidence. All right. All the best. I really pray that the Lord is going to be with you. The wisdom of the Lord will be upon you. You guys will remember everything you've studied. Nothing will confuse you guys. You know, when you get in that paper, you are just going to kill the paper. You are there. You are just going to win that paper. So all the best, guys. See you. Good night.
Bye bye.
Bye.